Hello everybody, it's me the Boss Hog, and today we're going to look at my stock portfolio as of the weekend ending the 8th of April at 101k, a new tax year, lots of buying this week. Let's do it. Alright, so first of all, I actually had something I had to do at work on in the evening, so I didn't do a day close. So there's only 4 days this week, basically. Look at the 8th, that's the Thursday and Friday results in one go. Sorry about that. It was a pretty interesting week, honestly, quite split. My US shares really suffered. I got some tech weighting, some growth stocks, definitely not the prettiest market, and I basically don't have any exposure to the few areas that were green. On the good side, I had a relatively good, I would say, UK week, but notably one of my largest holdings had a particularly good week, which more or less underpinned that. I wouldn't be profitable without one of the shares that we'll touch on in just a second. Right, so I added just 2,880 this week. It's probably a slightly weird amount. The reason for that is basically, so we get £20,000 a year per ISA, individual savings account, because I do my own and my wife's. It's basically, in order to top that up over 50 weeks, it's £400 a week, right? 400 times 50 gives us our 20 grand. And which works out £80 a day. So what I did here is I basically took £80 a day, multiplied by the 18 working days in April, and just decided to put everything in one lump sum, basically. So that was the rationale here. So, and then obviously did that times 2. So it was good, proper capital added, and again, that's going to be the target this year, is to basically add £800 a week moving forward. So let's see if we can do that. There was also a reasonable amount of trading this week. I profit took on two of the top 10 shares that we have. I still have sizable positions in them. They're still both in the top 10, but yeah, there was a couple of fairly chunky sales, primarily because I thought like there was some buying opportunities elsewhere. So again, that kind of feeds into our buys for this week. There was one divvy. It's just for Vicky. I have just the one share actually. I did have a few more. I've never had a huge position in Vicky. I consider anything under 28 here a good buy, and I would like to increase my exposure to Vicky whilst it still, at least to me, looks relatively cheap. But at the moment, I just have one. I've been putting money elsewhere effectively. So that's the summary this week. It was honestly an okay week. Some challenges, sure. Still, the markets could be friendly, it's quite volatile, but from my perspective, it actually felt really good to add capital and start the new year, so I was excited about that. Anyway, let's have a look at our top 10 next. Okay, so our top 10 as a weighting of our portfolio decreased from 88.6% to 84.1%. That's really just as a result of me opening some new positions and buying a fair number of things outside of the top 10, so obviously it went down. I'm mostly going to focus on big movements this week and any news, but actually there's not a ton of news this week. So National Express was up modestly. It's still my largest holding. I still think it's materially undervalued. The Motley Fool basically made the same observations that I make in terms of it's a good turnaround. It's well hedged out to 2023 in terms of its fuel. It fits in very well with the government's travel agenda, as well as moves to green travel, etc. So things I've said before. I also expect the dividend to be restored later this year as well. So looking forward to that. So still my largest holding. Gamma continues to struggle. No news on this, but just to say it's down another 6%. This stock has already beaten up over the last year, as you can see. I still think it's a quality outfit in the telco sector. So yep. Games Workshop, no new news this week, but it continues its gradual recovery. At one stage it was at £120 a share. It went down as low as I think about 60. Now it's up to about 76, something like that. So I'm still red on this, but it's climbing. Hollywood Bowl has been the best performer for me for probably over a month now. I mean, you can see the month-on-month change here is 32%. This would have actually become my second largest holding, except from I sold some shares, so it remained in the 4th place. But again, I mean, it really beat results. For me, I mean, I've made some projections, and basically, looking at their H1 and projecting it forward, and then taking the profit, from historic norms. I'm now sort of penciling about £31 million profit for this business. Previously, I'd been between 28 and 32, but actually it's settled on 29. Now I think actually it's more like 31, and so on the upper end of my own estimates, which were already on the upper end of analyst estimates. So we shouldn't be too surprised. My opinion, which Hollywood Bowl also shares, is that ultimately this is good value family entertainment that people still want. It's the best in class in the UK bowling sector, I would say. And last week it was already doing well on basically sympathy, a kind of weaker and smaller competitor put out pretty good numbers as well. So it already had a pretty good week last week, but continues to just climb. I would say now this is approaching fair value. I think though you could say fair value is now about 300p. Over the last 6 months, I've gradually notched that up from like 280 to 290 to 295. I think with the latest results, 300p is quite reasonable. Hollywood Bowl also said they'll be restoring a dividend later this year. The analysts are actually slightly lower than me on expectations. The guidelines seem to be about 7 to 8p for a dividend. I'm more expecting like about 11p for the total year dividend, something like that. And that's based on the fact that historically they kept to a 50% payout ratio. So I'm basically taking the shares, taking that 31.3 million, and then basically arriving at 11p, something like that. So that's my rationale there. So I'm actually slightly ahead on dividend expectations here, which again, even after the sell, I have thousands of shares, so that would be a very material dividend even when it arrives. Amcor got spanked basically this week, and the semiconductor space in general didn't have a good week. I think that it still remains an extremely good bargain. I've said previously that Gamma might become my largest holding this year because I think it's so undervalued. But actually, I would say that at current levels, like I'm going to be putting a lot of money into Amcor under $20. Like I think that is ridiculous for a company that has a current, or I guess 2021 price to earnings of $2.62 a share. Right, you're talking of like 7.3 historic PE, and again, like this is a company that's putting out record revenue, earnings, etc. So for me, it's just a clear value play in an incredibly expensive sector of the market. I don't really know what else to say other than that. It's getting really punished. The last one really here I'll talk about is just Phoenix. It had another buy recommendation from the Motley Fool. Morgan Stanley continues to rate it as overweight, but actually it's slashed its price target from 740 to 710. I would note that's one of the lower price targets. Last week we were talking about a couple of analysts putting it as 770, 800. I tend to be about 740 is my guidelines here. If I'm honest, I've not looked at Phoenix for a few months, so I'm slightly out of date, but that's my kind of estimate. Originally I was 720, and then I've put a little bit extra just because they're moving in the direction, but I'm not super close to it yet. So that's my target here. So I still think it's a screaming buy at like 620 or whatever it's trading at the moment, as well as like an 8% dividend. So this is also going to be one of my chosen stocks in over the next tax year. The rest of the shares here had difficult weeks, but no news. Basically, they just fell in part of like broader financial pressure or tech pressure or etc. So nothing else to add. And now let's have a look at the buys this week because there's quite a few of them. Okay, so feedback I've had previously on this channel was to talk about fewer of the stocks, but go into a bit more detail. So that's why I've only picked 5 here in the light green I like to talk about. Before I do, I just wanted to highlight the big 4 tech companies here. We're going to be averaging into them very emotionlessly over the next year to build up modest size holding in them. I want to get to about £1,500 in each one. So we're going to be looking at just over £100 a month. Averaging into each one of these, so that's going to be the plan moving forward. We did £100 here just to represent 3/4 of the month effectively, but that's going to be the approach for these 4 companies. So I'm trying not to think about them too much. I just think they're all good in what they do. Microsoft is my highest quality of these. I would say between Amazon and Google would be the best value of them, but again, we're just going to like these for different reasons and average into them. So they're going to be here throughout the year, basically, but I'm not going to do a ton of talking about them unless there's some really big news. Right, so first of all, I want to talk about Huntington Bank shares. I was actually quite surprised how much money I've made off of this. This is like my 4th time back in Huntington. I'm up basically £1,000 profit across those trades, even though I've never owned more than about 3% of my portfolio in them. I've had an uncanny knack of timing H-band, arguably, I think actually, objectively speaking, better than any other share I've traded. I think it's now fully integrated. its bank purchase. It's also in the process of acquiring like an investment manager at the moment to beef up that side of its business as well. I really like it. I think it's got good exposure to the Midwest. It's in consumer and business sector. Almost all of its metrics are moving in a positive direction. I think it's kind of hard to pigeonhole the company because it's got like good growth cross prospects, solid yield, 4.3% yield, something like that. It's just an all-round play in the middle of the S&P 500 in terms of market cap size, and I just really like it. I think it's a very well-run, smallish, but still now a top 10 regional US bank. And again, I'm just planning on keeping on buying here under $14. I do think you need a reasonable margin of safety for this one, so I've decided I'm going to be really disciplined and only buy under $14. But I maintain the $17, $20 share price target I've had for a year now. I think that's still a good target price for this company. It has had execution risks, but actually seems to be doing a great job of kind of converting those customers into Huntington customers. And like I said, all of the numbers to me look encouraging and promising. And I like financials at the moment. Banks will benefit from seeing their margins increase as base rates go up. And I think, central banks have been very slow to move to inflation. I just think they can't put it off any longer, basically. So again, for me, I was kind of surprised to see the weakness on the banks when it seemed like the Fed was moving forward in its urgency, finally, of increasing base rates. So I think the reading of that is because the wider expectation is maybe the economy is suffering. I kind of get that banks are exposed to that, especially more local banks. But again, I still think this is a good risk reward player under $14, which is where I'm at. I'm at like 13.81. So as an average, so really happy with that, honestly, super happy. Next up, we got Disney. Now, I think, I know actually I am ahead significantly of analyst targets on this. I was actually having a chat with ISA Investor. He's got a YouTube channel, definitely check him out. He's got a pretty sizable crypto portfolio as well, if that's your thing. I think sometimes I have higher valuations than him, but I think we were in agreement that, like when you look at the analyst guidelines here, it just doesn't really work. Like if you look at Q1, it was something like a 75% beat against analyst expectations. And I just think, like the $4 that they're penciling in for earnings per share is way too conservative. For me, I've got $6 a share. So picking this up at like $131, that's like a PE of 22. And I think a PE for 22 for Disney, like this is a company which is a very good long-term player, I would say. And I don't think it's even that expensive for a company of its quality and the ability to scale in the way that Disney can. Yeah, there's some risk here in terms of both streaming, and it's running into large companies, right? Even by Disney standards, it's running into your Googles and your Apples and Amazons, etc. But and likewise with COVID, right? The parks are not yet actually, although they're very close back to pre-COVID record levels. They're about 4% down on that at the moment, but I expect that to catch up as well. And again, this is a beast of a brand and a company. And before COVID, its EPS was something like $8.80. So and since then, its streaming service has really got up and running. Yeah, like I say, the parks still aren't there yet, and yes, it's having to spend more to create content and those kind of things. So I totally get it, right? It's not back to 2018 levels yet, but to me, I just don't understand some of the analyst earnings estimates. Like if you honestly believe that this is going to be a $4 a share earnings, I don't think you can justify picking this up for $130, right? You can definitely look at other YouTube channels and they'll be like, yeah, I'm not buying it above $100. And the basis of that is, I don't want to pay a multiple that's more than 25. And I kind of agree, right? That's the multiple level for me. So for me, the difference here is just what you expect the EPS to be. If you think it's going to be 4, you shouldn't spend more than $100 on Disney. If you think it's going to be 6, for me, I'm going to keep buying Disney up until about 150. So, my plan with Disney is probably to buy something like half a share a week, something like that, as long as it's under 150 and just keep buying. I think it's one of those really good long-term conviction plays. So this is my rationale here. So Redrow here, this is a UK house builder. I said last week that you can basically throw an arrow, throw a dart into the house building sector and pick any UK house builder at the moment. I think they are overly beaten up. I think the long-term macroeconomic trend here is basically the UK isn't building enough houses. It's one of the few Western nations that's expected to see its population increase. UK people love buying houses anyway. It's like, an Englishman's home is his castle, right? And we're just not building them. As far as I can tell, there are two main things that are driving pressure on house builders at the moment. The first is a provision for a cladding scandal. I like Redrow specifically because it hasn't built a ton of flats where cladding was used, right? This is a company that mostly builds like suburban homes. It's mostly been building them in the past in London and the southeast, where turnover was slow, planning permission took a while, and costs were high. But now it's like moving out into the north and broader suburbs, so it's going to be improving those slowdowns. It's going to be basically delivering more, faster, and with higher margins. So even though I expect to see some pressure on revenue, I expect to see earnings improve basically with Redrow here. And I think they're minimally exposed to the cladding scandal. So again, I think like although they've fallen, basically although I think the sector as a whole is undervalued, I think Redrow in particular is significantly undervalued. It also has a solid yield to support it. And although there are probably safer house builders, like Persimmon would be a good example, maybe Barrett, Taylor Wimpey as well is a good one. There are lots, right? And likewise, you could also look at Vistry in terms of the other value play that I considered myself, but decided just to stick with Redrow. So, but there are lots here that kind of give you good yields or good safety or maybe good turnaround or good value. Redrow is my pick, and my average is now at 570. Buying shares here at like 520 just feels again really good to me. So I'm just gradually averaging down and looking to increase my stake in Redrow. I've nearly gotten it to the level where I'm happy. I'd just like a few more shares basically in this to get like a 1.5% of my portfolio here. Amcor I obviously mentioned. I have a buy price here of $22, so it's in the high 22s. Can't remember what it is off the top of my head, but to me, being able to buy under $20 is really good, as I've already touched on. So this to me is like a growth and dividend growth play, and it kind of aligns with my strategy of buying small to medium sized, good quality, profitable companies this year that can potentially in the long run multi-bag. So this is my one of my stronger convictions, to be honest with you. I didn't actually originally plan to buy a ton of Amcor because it looked like it had gone into the 24s, and I was basically just happy with my stake. But again, under $20 for me is a screaming buy, and I will probably, depending on exactly how far under 22 the share price is, will depend on how forceful I buy into it. But I will keep buying under 22, and under 20 I'll buy quite aggressively. So again, here we picked up 29 shares eventually. And I've got, I think it's 581 shares now in this company. So again, a big conviction for me. And the other one I really wanted to talk about, just because it hardly gets any airtime, even though I feel like I know the business extremely well. So this is Cerulean. They are a very small company, about $250 million market cap, something like that. The reason why I know this business so well is because it's basically my day job. They do billing systems, CRM systems for telecoms companies, which is literally, again, what I do for a living. I've also had talks with senior account directors at this company. I know the business inside out. I demoed the product, reviewed the way the billing system works, right? It's just like I know the business really well. It's a solid, well-run business. It's been scaling for like 20 years. Recently, I think it hit a point where it started to acquire some very large customers in sort of South America. I think like a 15 million contract value customer. So again, that's significant for a company that's only worth 250 million, right? So it's now kind of got a system, a solution more generally that really I think is appealing. It's a company that I would consider buying a solution from, again, for my day job. And so, that's basically the biggest endorsement I can give it. Otherwise, the only other thing to mention here, depending on whether you think this is a good or a bad thing, the founder still has about 30% of the business in it. So I know some people really like that. Other people might like it less. But the founder is an industry veteran, and again, this has been a slow growing company for many decades now, but basically it's achieved scale. So even though I had other things that I could have like averaged down on more aggressively, I decided actually to put just a couple £100 here, but I just wanted to talk about them a little bit. So I still only have a relatively small position in Cerulean. This is about my buy price. I think my buy price is 750. I'm buying anything under £9. I think that's a good risk reward here. And at the 760 level, you're looking at a current PE of mid 30s, which again, it is expensive, but it's rapid growth stage at the moment. Again, it's kind of it's got past that kind of like unproven stage. So again, I'm expecting significant growth from this company. And again, I think although that is a hefty multiple, I think kind of this early stage high growth company justifies that multiple. So my rationale here anyway. If I haven't spoken about something that you're interested in, feel free to ask in the comments and I will respond. Now let's have a look at what I sold. All right, so a much shorter list for this. So Hollywood Bowl, I decided to sell 20% of my share stake, I guess. I had 5,000, I sold 1,000. I mean, the results were great. It did beat my expectations, but I was expecting some good results here, to be honest with you. My eventual plan, I think, with Hollywood Bowl is to get to about 3,000 shares. So I am still considering, I mean, I am planning to sell another 1,000 shares eventually. And then from about 3,000 shares, I'm planning on keeping it, right? That should, by the time we get to that stage, I expect to be having a look at a £3 a share kind of price. So I'll have like £9,000. That will be sort of about 9% of my portfolio. And I think that's just a really healthy number for a quality business. And that percentage will gradually drift down as hopefully portfolio grows and new capital is added. But I like the company. It still is a good one for me to have. And again, I like the safe bet in the consumer discretionary sector. I love the brand of this company as well. It's kind of got that slightly retro feel to it, but it isn't kitsch. It's like really well judged and fun. Also as well, I think it has a superb management team for a relatively small company. This is like a 400 million market cap. But they've done a lot of great things during COVID to basically make their business more lean, more capable. I mean, everything has been like looked at, menus have been simplified, rents have been renegotiated, CRM has been updated, technology has been improved to, introduce surge pricing at busier times and vice versa at quieter times. Pins can be restacked quicker because of new technology. It's like everything's been thought about. It's really lovely to see. It's just a very well run and improving business basically. So I still like it. But yeah, I decided to sell 1,000 because I think here my target price would be either like high 2.9s or £3. Okay, I'm selling slightly below that, but I think a lot of the good news is factored in now until we see the results that are published in September, or sorry, year end is September. There isn't going to be a huge amount to move the share price, and I'm happy with this as an exit for a 20% share. So especially because it felt like this was holding up very well, whereas financials and retro were still struggling. So it just felt like a good opportunity for me to do a bit of profit taking here at 283. My average, I actually sold these in one chunk, so I got 283, which is I think actually at the top, so that felt, I guess, nice. Next up is TRow, a newish position for me. It's pretty interesting, the journey with TRow, because I was a bit sad originally because it went to like 155 and it recovered really quickly, and I had wanted to buy a few more shares, but then it went down to like 144. I was like, oh, okay, but it fell with everything else. And then something weird happened where basically I felt like JP Morgan, which I got a couple of shares in, HBAN, and like one or two, like Disney, didn't really recover as fast as TRow did. So I decided that this was, I'm probably like, really stretching margins here and stuff, but I felt like, I got a 146 sell on this. That number's in pounds, but it was $146 on these 10 shares. And basically I felt like, although it's probably about similarly undervalued for me between TRow and HBAN and JPM and those kind of companies, it was just an opportunity to sort of, again, profit take, redeploy, but to be clear, I would still actually consider buying TRow at 146. So I don't feel like I made a great sale here. It was just kind of an opportunity because I felt like there was potentially a little bit of a spread difference, if that's quite the right word, between two shares. And again, I really admire HBAN. I kind of regretted selling. I sold out previously at something like 1680, so I didn't quite get the top, but I was kind of happy with that anyway. And now I want to get back into it. So it's kind of, I think HBAN is more of like a growth and dividend growth and maybe more like long term, whereas TRow just feels like a more store of value, kind of wider proxy play. So I'm quite happy to have TRow for those reasons, but I just sort of, between HBAN and Disney, those are two companies that I think are good long-term plays. Disney is like more of a certainty, of course, but HBand's an exciting one for me. And again, if we're looking at kind of small but proven companies with potential to grow significantly in the future, HBand again for me really fits into that mold. I appreciate, like TRow for me was less of a kind of like I just had to do it, but I decided I wanted to basically. So that, I mean, that's what I did. So that was my rationale anyway. Like I said, I don't think I particularly got a terrific sell price for TRow by any means. Bowl I'm quite happy with, however, for my thing. But that's the rationale. So a slightly longer video this week compared to the last couple, just because as a result of the buying and selling. Just to let you know as well, I've got some family time over Easter, so I'm not going to be posting again for a couple of weeks, or certainly these type of videos, right? That's one of the reasons why I did a big deposit this week. I have pre-recorded some videos, so you will get 1 or 2 more videos from me about shares positions and share like company reviews. But other than that, that will be it for the next couple of weeks. So hopefully I'll leave you with this anyway. So otherwise, I'm done. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now, guys.